Hello and welcome to the third public meeting of the IEG for 2023. It is my pleasure to welcome you all. Before we begin, I'd like to note our standard disclaimer that the views presented during this meeting today are my own, and I'm not speaking on behalf of the board or my fellow staff members. We have a packed agenda for this afternoon, but I would like to give the floor to Amy McGarity to say a few words. Amy, are you ready?
I am. Thank you, Saba. I appreciate your patience. Also, thank you to the board and PCAOB staff for taking time with us today to discuss these important issues. As Saba mentioned, it is quite a packed agenda today. Also, thank you so much to the dedicated members of the IAG who've put in a lot of time and effort to develop much of today's content. With that, I'd like to turn it over to PCAOB Board Chair Erica Williams. Erica?
Thank you, Amy, and thank you to the members of the Investor Advisory Group for meeting with us today. I very much look forward to hearing from you. Before we begin, I also must provide the usual disclaimer that the thoughts that I express are my own and not necessarily those of the PCAOB board members or our talented and dedicated PCAOB staff. When we met in June, I asked for your help encouraging investors and audit committees to make use of PCAOB inspection data to hold firms accountable for delivering high quality audits. And as you know, earlier this year, we began including new information about independence and more in our inspection reports for the first time. In July, we expanded the tools available on our website to make it easier to find and compare deficiency rates across audit firms. And transparency is one of the most powerful tools the PCAOB has to drive improvements in audit quality. We remain committed to increasing that transparency. Ultimately, the responsibility falls on auditors to correct the problems that led to the deficiencies in their audits. The PCAOB will continue demanding firms do better. We have demonstrated that we will not hesitate to bring enforcement cases against auditors where appropriate, and we will continue to carry out hundreds of inspections each year. At the same time, accountability from audit committees and investors provides a powerful incentive to find solutions. And this is where your influence can make a big impact. Please use your networks to encourage investors and audit committees to review our inspection reports and make use of their findings. Encourage them to take note of which firms are consistently complying with PCAOB standards and which firms are not. Encourage them to apply that knowledge in assessing the auditors of companies where they invest or serve on the board. Share the questions included in our report that audit committees should ask their audit firm, including, has our audit engagement been inspected by the PCAOB? Were there any audit areas that required significant discussions with the PCAOB that did not result in a comment form? Has the engagement partner been inspected on other engagements? If so, what were the results of that inspection? And what is the audit firm doing to address overall increased inspection findings? Spread the word that investors can use their influence to engage with investor relations and audit committees of the companies in which they invest, and encourage them to seek out firms with proven track records on audit quality. Your input is incredibly valuable as we continue working to empower investors and audit committees by improving the information we share and the tools we provide to help analyze that information. Thank you for your insights. I know Saba is working with many of you and Todd Cranford, our stakeholder liaison, to find ways the PCAOB can help encourage more dialogue between investors and audit committees. Please continue to share your ideas with her. As I mentioned, we will not hesitate to bring enforcement cases against auditors where appropriate. I'm excited that you're going to hear directly from our enforcement team today about the work they are doing to make sanctions count and how they are working to expand how we identify cases and expand the types of cases we are pursuing. At the same time, Barb Vantage and her team are hard at work as always, and you'll hear more from her on our standard setting agenda in a moment. Since we met in June, the board proposed amendments to give auditors additional direction, addressing specific aspects of designing and performing audit procedures that involve technology-assisted analysis of information in an electronic form. And we issued a proposal on a rulemaking project that would hold associated persons accountable when they negligently contribute to firm violations that can put investors at risk. Thank you for your valuable insights that you shared in your comment letter on the proposed technology-assisted analysis amendments, and I look forward to your perspectives on the amendments we're proposing addressing contributory liability. Late last month, the board unanimously voted to adopt a new standard and related amendments on the confirmation process, which touches nearly every audit. The new standard will help auditors detect fraud and better protect investors now and into the future. And I want to thank you for your comments on that. Still, we have much work ahead of us, including firm and engagement performance metrics, which is on our short-term agenda. We believe certain performance metrics about accounting firms and their audit engagements may provide valuable context and perspective for investors, auditors, audit committees, and others. For example, such metrics may provide useful information to investors as they make investment and proxy voting decisions. And I'm interested in hearing your presentation today and the thoughts that you have in this area as we work towards issuing a proposal. Your work will continue to inform us. As we continue pushing forward the most ambitious standard-setting agenda and rulemaking agenda in PCAOB history, we are thrilled that Dr. Martin Schmalz joined the PCAOB in August to help inform that work as chief economist and the director of the Office of Economic and Risk Analysis. Martin is a tenured professor of finance and economics at the University of Oxford Said Business School, serving as the academic area head for the Finance, Accounting, Managerial Science, and Economics faculty group. He brings extraordinary expertise to the great work Michael Gerbett and the team in our Office of Economic and Risk Analysis are doing. Of course, our economic analysis and our work don't end once a standard is adopted. We continue to examine the impact of the standard through our post-implementation review process. That process is currently ongoing for critical audit matters, and I look forward to hearing your recommendations today as a follow-up to the CAM presentation that you presented at our last meeting in June. Finally, I want to acknowledge Board Member Desparti, whose second term at the PCAOB is coming to an end later this month. This will be his last Investor Advisory Group meeting, and reconstituting the IAG was one of the first actions we took together as a board. Dwayne, I want to thank you for your service to the PCAOB. We wish you well in your next chapter, and I look forward to continuing to work with you over the next few weeks. I also applaud the SEC's appointment of George Bodick to the board. Many of you know George well, and I know we are all looking forward to working with him in his new role. George will be leaving the Division of Registration and Inspections to the incredibly capable hands of Christine Gounier. Christine has been with the PCAOB since 2004, nearly as long as George. Since 2018, she served as the Deputy Director of DRI's Global Network Firm Inspection Program, where she's responsible for overseeing the inspections of the 6 largest domestic accounting firms, as well as their non-affiliated U.S. firms, non-U.S. affiliated U.S. firms. I look forward to working with Christine as she takes on the role of Acting Director of DRI. With that, I will turn the meeting back over to Saba and Amy, and thank you again for joining us today. I look forward to your presentations.
Thank you, Chair Williams. Our agenda for today includes an update from the PCAOB Chief Auditor about Vantage, a presentation from my colleagues at the Division of Enforcement and Investigations. Later this afternoon, we'll hear from members of the IAG and their chosen panelists on firm and engagement performance metrics and recommendations to enhance critical audit matter disclosures. But first, I'll give the floor to Barb to provide an update on the standard setting agenda since we last met in June. Barb.
Thank you, Slava, and good afternoon, everyone. Before I begin, I too need to provide the disclaimer for myself and my colleagues from the Office of the Chief Auditor that the views we express today are our own and not necessarily those of the board, its members, or other PCAOB staff. This morning, we'll provide a brief update on a proposal issued by the board since you last met in June, and also a recently completed standard setting project, our project on the auditor's use of confirmations. Now, we discussed the non-compliance with laws and regulations proposal with you at your last meeting. I did want to take the time to thank you for your thoughtful comment letter on that proposal. The comment period closed in August, and the staff are currently considering the comment letters received, and we will be working with the board in the upcoming months to determine next steps on that project. So on Monday, June 26th, the board proposed amendments related to aspects of designing and performing audit procedures that involve technology-assisted analysis of information in electronic form. As the title suggests, the amendments are narrow and they're designed to address some aspects of the use of technology in audit. They are not designed to be the answer to the use of technology by auditors. Rather, they're a first stepping stone and a part of our effort to improve investor protection by modernizing our standards. The use of technology-assisted analysis in the audit is not new, but what has been changing is the scope and sophistication of that analysis. Auditors have been increasingly able to obtain and analyze more information in different ways, to do that analysis earlier and throughout the audit, and to identify more items for investigation. And with that, some questions have arisen about how the standards would apply. We also heard from you that the auditor's use of technology-assisted analysis may be an area of concern due to the potential over-reliance by auditors on company-produced information, and that there could be a benefit in addressing that use in PCAOB standards. With that in mind, the amendments were developed to provide certain important clarifications and designed to increase the likelihood that auditors will obtain sufficient appropriate audit evidence in support of the opinion that you all rely on along with other stakeholders. For example, when using information that is generated or stored in electronic form, IT general controls and, if applicable, application controls are critical to the auditor's consideration of whether that information is reliable. Another example addressed by the amendments is that technology-assisted analysis can be an iterative process. A number of outliers could mean different things. On one end of the spectrum, it could mean that the analysis did not really take into account the actual process by which transactions are processed. But on the other end of the spectrum, it could indicate a material misstatement. So specifically, the amendments would address just aspects of designing and performing audit procedures where we've identified the need for additional specificity or clarity in the standards. I do want to thank you for your thoughtful comment letter. I'll echo Erica's thanks. And we are currently considering the comment letters received, and we'll be working with the board in the upcoming months on next steps. On September 28th, the board approved a new standard on the auditor's use of confirmation, which they proposed last December. As we noted at that open meeting, and as Erica said, confirmations touch nearly every audit. And so this is an important standard to audit quality and investor protection. Subject to approval by the Securities and Exchange Commission, the new standard and related amendments will apply to all audits conducted under our standards and will take effect for audits of financial statements for fiscal years ending on or after June 15th, 2025. Thank you for your comment letter on that proposal. Dima Andrienko and Heather Jossam, who led the project team, will now provide an overview of the final standard. Dima?
Thank you, Barb, and good afternoon, everyone. The board adopted the new standard on confirmation after substantial public outreach. This included a concept release and 2 proposals, the most recent of which was issued by the PCAOB less than 10 months ago. Commenters on the proposal generally supported the objective of improving the confirmation process and suggested areas to further improve the new standard. In modifying this proposal and developing the new standard, the board has taken into account all of these comments, including comments from members of this advisory group. The new standard is designed to provide robust, principles-based requirements that apply to all methods of confirmation, including paper-based and electronic. Importantly, the new standard strengthens existing requirements by focusing on the need to obtain relevant and reliable audit evidence directly from the knowledgeable external source and maintain control over the confirmation process. Information obtained by the auditor directly from a knowledgeable third party, such as cash confirmation from a company's bank, can be an important source of audit evidence. Confirmation has long been used by auditors to obtain such evidence. Further, the new standard modernizes existing requirements to reflect the wider use of electronic means of communication in audits and the continuing development of technology for accessing third-party information directly by the auditor. Thus, it improves existing standards by providing principles-based requirements that apply to all methods of confirmation, including paper-based and electronic means of communication. I'll touch briefly on the integration of the requirements for the auditor's use of confirmation with the requirements of the PCAOB's risk assessment standards and situations in which the auditor should use or consider using confirmations in the audit. The existing standard on the confirmation process predates the PCAOB standards on risk assessment, which were issued in 2010. The new standard addresses how the auditor's use of confirmation works in concert with the risk assessment standards. The PCAOB's risk assessment standards acknowledge that evidence obtained from a knowledgeable source outside the company generally is more reliable than evidence obtained only from internal company sources. When properly designed and executed, the confirmation process can be an effective way of obtaining relevant and reliable audit evidence, including in situations where the auditor identifies an elevated risk of material misstatement due to error or fraud. Commenters on the proposal, investors in particular, spoke about the importance of obtaining relevant and reliable audit evidence for cash and accounts receivable. For example, the existing standard does not separately address auditor responsibilities for confirming cash. The new standard includes specific requirements for cash and accounts receivable. Under the new standard, when auditing a company's cash and cash equivalents held by a third party, the auditor should perform confirmation procedures or otherwise obtain relevant and reliable audit evidence by directly accessing information maintained by a knowledgeable external source. Confirmation of accounts receivable is a long-standing audit procedure typically used by auditors. Already the existing standard includes a rebuttable presumption that the auditor will perform confirmation procedures. The new standard not only carries forward this presumption, it improves existing requirements. The new standard more clearly addresses situations where it may not be feasible for the auditor to obtain evidence directly from a knowledgeable external source. This may occur, for example, when auditing companies in certain industries. The new standard outlines how the auditor determines that obtaining external information directly is not feasible and requires that the auditor perform other substantive procedures, including test of details to obtain external information indirectly, and provides examples of doing so. When such situations occur, the new standard emphasizes the auditor's responsibility to document in the audit working papers their determination that it was not feasible to obtain audit evidence directly from the knowledgeable external source. There's also a related new audit committee communication requirement that I will mention in a few moments. Some of the commenters on the proposal also suggested that certain specific transactions ought to be subject to confirmation. Requiring confirmation for such additional items in all cases without regard to the audit's facts and circumstances would be too prescriptive. The new standard focuses on difficult audit situations where the auditor has identified a significant risk of material misstatement, including fraud risk. More specifically, the new standard requires that the auditor should consider confirming those terms of complex transactions or significant unusual transactions that are associated with a significant risk of material misstatement, including fraud risk. Commenters on the proposal from the investor community also emphasized the importance of audit committee communication. The new standard includes a requirement for communicating important matters related to confirmation to the company's audit committee. For cash and accounts receivable, the auditor should inform the audit committee when the auditor did not perform confirmation procedures or did not otherwise obtain audit evidence by directly accessing information maintained by a knowledgeable external source for significant risks of material misstatement. This new communication requirement is designed to enhance the audit committee's understanding of the auditor's strategy for dealing with significant risks related to cash and accounts receivable. In addition, as with other matters arising from the audit of financial statements and communicated or required to be communicated to the audit committee, PCAOB standards require that the auditor determine whether these matters are critical audit matters to be included in the audit report on the company's financial statements. Now I'd like to hand this over to Heather Johnson, who will discuss some additional aspects of the new standard. Heather.
Thank you, Dima. Good afternoon, IAG members. This afternoon, I will discuss 3 additional aspects of the new standard. First, the auditor's responsibility to maintain control over the confirmation process. Second, the use of negative confirmation requests. And third, situations in which other procedures should be performed by the auditor as an alternative to confirmation for selected items. The new standard emphasizes the auditor's responsibility to maintain control over the confirmation process to minimize the likelihood that information exchanged between the auditor and the confirming party is intercepted or altered. This is because the reliability of audit evidence provided by confirmation depends in large part on the auditor's ability to control the integrity of confirmation requests and responses. The new standard provides that the auditor should send confirmation requests directly to the confirming party and receive confirmation responses directly from the confirming party. In consideration of comments received on the 2022 proposal, the new standard clarifies how an external auditor can use internal auditors in a direct assistance capacity as part of the confirmation process. In order to maintain control over the confirmation process, the new standard states that the auditor should select the items to be confirmed, send confirmation requests, and receive confirmation responses. In addition, the new standard requires that the auditor perform certain procedures when an intermediary is used to facilitate direct electronic transmission of confirmation requests and responses. The use of an intermediary does not relieve the auditor of the responsibility under PCAOB standards to maintain control over confirmation requests and responses. Because an intermediary's involvement may affect the integrity of information transmitted between the confirming party and the auditor, the new standard provides that the auditor should evaluate the implications of using an intermediary on the reliability of confirmation requests and responses. The new standard specifies certain procedures to be performed as part of the evaluation, including obtaining an understanding of the intermediary's controls that address the risk of interception and alteration, determining whether such controls are designed and operating effectively, and assessing the relationship of the intermediary with the company. The new standard also clarifies that when the auditor determines the risk of interception and alteration of confirmation requests and responses at the intermediary is not addressed, the auditor should not use an intermediary to send confirmation requests or confirmation responses. Next, I will discuss the use of negative confirmation requests under the new standard. With a negative confirmation request, the auditor requests a confirmation response only if the confirming party disagrees with the information provided in the request. The auditor generally obtains significantly less audit evidence when using negative confirmation requests than when using positive confirmation requests, because the auditor typically doesn't receive a confirmation response unless the confirming party disagrees with the information provided in the request. The new standard acknowledges the limited evidence provided by negative confirmation requests and states that the use of negative confirmation requests alone does not provide sufficient appropriate audit evidence for addressing the risk of material misstatement to a financial statement assertion. Finally, I'll discuss situations when the auditor performs other procedures as an alternative to confirmation procedures for selected items, also referred to as alternative procedures. Under the new standard, alternative procedures are substantive audit procedures that an auditor performs when they're unable to obtain relevant and reliable audit evidence about one or more items selected for confirmation. The new standard provides more specific direction for circumstances where the auditor is unable to obtain relevant and reliable audit evidence through confirmation. The new standard identifies certain situations involving confirmation where an auditor should perform alternative procedures for selected items. The first such situation is when the auditor is unable to identify a confirming party who would provide relevant and reliable audit evidence in response to a confirmation request. The second is when the auditor is unable to determine if a confirmation response is reliable. And the third is in the case of a non-response or an incomplete response. In addition, the new standard provides that the auditor should perform alternative procedures when the auditor is not able to use an intermediary, yet would be unable to send confirmation requests for selected items without the use of an intermediary. The new standard includes examples of alternative procedures that may provide relevant and reliable audit evidence for selected items of cash, accounts receivable, accounts payable, and for terms of a transaction or agreement. These provisions expanded upon the alternative procedures discussed in the existing standard on confirmation. Additionally, to remind auditors that the auditor's assessment of risks of material misstatement, including fraud risks, should continue throughout the audit, including the confirmation process, the new standard states that when the auditor is unable to obtain relevant and reliable audit evidence about the selected item through confirmation, the auditor should evaluate the implications for the auditor's assessment of the relevant risks of material misstatement. The rulemaking also includes amendments to several of the board's auditing standards to conform to the requirements of the new standard. This concludes our prepared remarks. We would be happy to answer any questions you might have.
Thank you, Heather. Thank you, Barbara.
Just say a few more words. Unless you have questions, that concludes our update. I would say that hopefully in the next few weeks, we'll be updating our public standard setting and research agenda. So please watch for that update. And again, I want to thank you so much for engaging in the standard setting process. We do appreciate that you're all very busy people. Jeff, I see you have a question.
Thanks, Barbara. Thanks for that very thorough report. My question, Barbara, is when you began with your discussion of the amendments related to the auditor's use of technology, I believe you said, and you may have said this previously as well, that that project had a fairly narrow scope. So my question is it possible for the PCAOB to have a very narrow scope amendment to an existing PCAOB standard? It seems like that was the case in this project. So is that possible for other standards as well? Thank you.
Sure, I believe that's possible.
Thank you.
If there aren't any other questions, again, I just want to wish you all the best until we meet again in the new year. It's hard to believe that it's almost year end. So thank you all. And I look forward to hearing both presentations today.
Thank you, Barb. And just a reminder, the PCAOB's proposed rule on 3502, which governs contributory liability, is out for comments. So please submit your comments. The deadline is November 3rd. Does anyone else have any questions? If I don't see any. I don't know if Amy, you're trying to fix your camera or it's.
I'm just paging through to see if I see anyone with questions, that's all.
Okay. So we can just move on to, this gives us more time for the next session. We can move on to the next presentation on the agenda, which is from an overview of the PCAOB's enforcement process. Unfortunately, Bob Rice was scheduled to present and lead the presentation, but he got COVID and is unable to join us. To do the honor, Mike Davis, John Abel, and Kara Armstrong will be presenting. We have shared their bios yesterday, so please refer to that for details. With that, I will give the floor to Mike.
Well, thank you very much for the opportunity to speak to the group. My name's John Abel, and I'm the chief accountant in the Division of Enforcement and Investigations. And presenting with me today are Kara Armstrong and Michael Davis. And we're just going to talk about an overview of the Division of Enforcement and Investigations, and get through our slides and hopefully have some time to take any questions that you have. With that, Brian, do you mind just turning to the first slide? So this is our standard disclaimer that the views that we express are our own and do not necessarily reflect the views of the board as a whole, any individual board members, or other staff. And, you know, one of the things we wanted to make sure that we discussed with you is how the board is strengthening the enforcement program and how our work is strengthening not only what we're doing, the message that we are sending to the audit firms that we're very serious about enforcing egregious conduct, and that egregious conduct will be addressed with stiff sanctions. You can see here on the slide that part of what we are looking to do is rigorously enforce the PCAOB standards, the rules that are relevant to auditors and the conduct of audits, and relevant laws, including the SEC's rules and laws that are relevant to audits. We're making sanctions count. That means higher sanctions. That means not being able to access indemnification. And we'll talk about some cases that exemplify that. And we're also expanding how DEI, that's Division of Enforcement Investigation, how we identify cases, looking at a broader panoply of potential issues to investigate, working very closely with our inspections group to understand what they're finding, to make sure that they understand the fact patterns and the heightened risks, areas that we believe are heightened risk of potential audit problems, such that we can identify where those things are being seen by our inspectors and investigate them as deemed necessary. And then lastly, expanding the types of cases that we pursue to include not just violations of PCAOB standards, but making sure that we're evaluating firm culpability when there are audit busts. What was the response? How was the firm involved in it? If they were involved in it, were there policies that weren't really up to snuff? Were there gaps in policies and procedures? Were there consultations with national office people? And is there some allocation of blame that goes to the firm? As well as looking at things like compliance with our rules and forms, and making sure that things like the cases that we've done involving failure to supervise, which was something new under this board, that we continue to push for enforcing those rules where the underlying conduct supports charges. You should move forward, Brian. Next slide, Brian. So the Division of Enforcement Investigations investigate violations or possible violations by registered public accounting firms and their associated persons as they relate to violations of the Sarbanes-Oxley Act, the rules of the board, the provisions of the securities laws, and in the preparation and issuance of audit reports, and the obligations and liabilities of accountants. and this includes the rules of the commission that relate to the performance of audits, and of course, PCAOB standards. The board may impose a variety of sanctions if violations are found, and we'll talk a little bit about what those sanctions are. And the board exercises its investigative and enforcement authority through our group, the Division of Enforcement and Investigations. Brian, do you want to just jump forward one more slide? So when we talk about the priorities, what is the Enforcement Division prioritizing in its work? First and foremost is investigating significant audit violations that present risks to investors. These are audit failures. These are matters that often involve multiple years of audits and significantly egregious conduct. This may manifest itself, and we may find these in, looking at where companies have restated. We look at the issues and decide to investigate and determine whether whether the auditors did what they were supposed to do as it relates to auditing the areas that ultimately were restated, relates to independence, and it also relates to, again, a lot of the findings that our inspections group are finding and referring to us as matters that are more egregious and need to be considered for investigation. The second bullet here is matters threatening or eroding the integrity of the board's regulatory oversight process. And what this primarily involves is where audit firms and their associated persons fail to cooperate with an inspection. Typically, this fact pattern is that a firm and its associated persons find out that there's going to be an inspection of a particular audit. They modify the work papers associated with that audit to be inspected so that those work papers do not reflect the work papers that were present at the time that file was archived. Clearly, it undermines the process of our inspections and doesn't give the inspectors an opportunity to evaluate what the work looked like and the work that was performed at the time that the audit report was released, and then the ensuing time that that team has to document that audit. We also there are instances in which we run into non-cooperation with our investigative process, and we will certainly investigate that, and there are actions on our website that relate both to non-cooperation with our inspections process as well as with the investigative process. We have zero tolerance for that type of behavior. The last bullet at the top here is audit matters related to significant independence violations. Again, independence is a bedrock of a professionally skeptical and objective audit. It is very important that these independence rules be upheld, and so where there are indications that there are violations of those rules, we investigate those, and we brought a number of actions related to violations of the independence rules. In the second section here, you'll see that we're also focusing on deficiencies in the firm's quality control policies and procedures. I had mentioned that we are looking at the firm's culpability as it relates to audit failures in individual or in individual audits, but we're also looking at where there are trends in quality control areas that may arise as a result of multiple inspections, that may arise from some combination of matters that inspections has found, and then that we identify in the investigations that we're doing. We think that it's very important that the firms do have systems of quality control that provide them with reasonable assurance that the relevant rules are being followed, and where there are indications that they're not, we're going to investigate those. We're also expanding the types of cases we pursue. I had mentioned the failure to supervise example, and another example are single acts of negligence, where you have serious conduct that requires us to get in there and look to see whether, even though the auditor's conduct may be negligent, it can be tied to some significant consequence. A potential fact pattern may be a very significant restatement where there is auditor culpability. Again, not rising to the level of recklessness, but there is this serious, there's a serious issue, i.e. a big restatement, and there is some tie back into ultimately the auditor's conduct and whether they sufficiently audited the area. Brian, could you jump forward? So I mentioned before the range of possible sanctions, and in terms of using all the tools in the toolkit, we are thinking about applying these various sanctions if the fact pattern supports it. You look at civil money penalties. We'll talk about the numbers in a couple of slides, but the civil monetary penalties that the board has sanctioned firms for have grown significantly. That provides deterrence to the individuals and the firms in question in doing such conduct again. It also provides a warning for other auditors who are reviewing those orders that if they find themselves having done the same conduct, that there are going to be significant consequences as it relates to the civil monetary penalty that we'll be seeking in an enforcement action. Suspensions or bars of individuals from associating with a registered public accounting firm is an extremely significant sanction. And you will see that it is also a sanction, unfortunately, that is frequently included in our orders. This prevents a bad actor from performing audits on issuers or registered broker-dealers. In addition to that, there are instances in which the firm's registration is either temporarily or permanently revoked. Again, very significant sanction that you will also see in a number of the board's orders. We also have used limitation of activities as a way to address conduct that may not be quite as egregious as what would result in a bar or revocation. But in this case, it is a way to help protect investors by limiting the activities of an individual, perhaps to sign audit reports, to function as an engagement quality reviewer, or to perform in different roles. And we'll actually talk about in one of the example cases where this was one of the sanctions. We'll talk about how that worked in that particular case. Also requiring undertakings, such as additional continuing professional education related to the areas that were subject to the deficiencies in that order. Appointment of an independent monitor or consultant is something that we have looked at and that the board has sanctioned firms and required in a number of recent orders. This has a number of different positives to it. One, it allows the board to understand what is going on within that firm, whether they are making the improvements that they need to make to address the issues that were subject to the enforcement action. And it's a way that we can see whether the improvements are happening, whether they are substantial, and oftentimes it is something that is combined with a temporary or permanent revocation or with a limitation, maybe limiting a firm from taking on new clients until such time that they've addressed the issues that were subject to the enforcement action. And it gives a much better mechanism by which we can understand whether the firm is doing that, given that there's an independent monitor who has no real incentive in kind of passing the firm on meeting its remedial measures. Lastly, we impose censures, and there are other sanctions, but these are the primary sanctions that the board has ordered in recent actions. Brian, next slide. So I talked a little bit about what a bar or suspension means, but essentially if an individual is suspended or barred, they cannot work on issuer audits or the audits of registered brokers or dealers. They also cannot associate in a way by which they get remuneration from those audits. So it goes beyond just doing the work on audits. It also goes to the financial remuneration from those audits. And in instances, there have been matters that we've investigated where there are questions as to whether individuals are receiving financial remuneration. And obviously whether they are people who are associating when they are suspended or barred. We're not only looking at what the conduct is for the individuals, but we're looking at whether the registered firm has allowed a suspended or barred individual to associate. And so that's another aspect of certain enforcement cases or certain enforcement investigations that we've done. So it's not just conduct related to the individual, it's also conduct related to the firm and whether they are allowing someone to associate. So we also coordinate very closely with the SEC. And by statute, the PCAOB may share information with the SEC, may also share information with the Department of Justice and other agencies enumerated in the Act, which include the federal functional regulators, like the banking regulators, and FINRA. We coordinate with the SEC as standard practice. There are frequent meetings with the SEC on investigations, and there may be instances in which we have parallel investigations. There are also instances in which we look at the auditor conduct while the SEC investigates the public company and its management. There are also instances in which we're both looking at the auditor. And there are also times when, based on certain factors, maybe how far along the SEC is or how far along we are, one or the other will defer the audit investigation, again, based on certain factors. All right, so I'm going to go ahead and turn it over to Kira for the next slide. Brian, do you mind?
Actually, John, I can jump in here.
Okay, great.
This is a very exciting portion of our slides. It's an overview of the 2022 published enforcement orders. Last year was a very strong year for DEI. We had 42 public enforcement orders that we issued. 41 of those matters were settled orders, and one was adjudicated. That was double the number of orders we had in 2021. Our primary goal is, as always, to protect investors. And so we're not specifically looking for any particular number of orders that we seek to request that the board enter in any given year. But last year was a very strong year in terms of the number of orders that were issued. Also, very interestingly, more than half of the public enforcement orders issued in 2022 were against firms or individuals outside of the United States. And many of these cases involved a number of issues, including QC as well as audit issues. And the vast majority of them were started during the pandemic, which was a very difficult period to conduct investigations, as you can imagine, trying to conduct an investigation involving a foreign firm and a foreign audit. So we felt that this was quite an accomplishment, that we were able to continue to pursue our mandate and to bring matters and to conduct investigations, in spite of the fact that many of these would have been started in 2020, 2021, or even earlier. Can we have the next slide, please? So further to that theme, as you can see, we had 17 settled enforcement orders in 2020, 21 in 2021, and in 2022 we had 41. Already this year through September 30th, we've had 24 orders. Of course, no one can predict the future, but we also think we're going to have a strong year this year. Also, if you look at the civil monetary penalties, you can see that in 2020 we had 1.5 million, then a dip in 2021, and last year 10.9 million. And again, so far this year, through the first 3 quarters of the year, we've already had $7.6 million in civil monetary penalties. The PCAOB's strategic plan is sought to strengthen the enforcement program through rigorous enforcement of standards, rules, and laws. Bob Rice, who, as you know, couldn't make it today, one of his favorite sayings is he likes to be aggressive, but appropriately so. And that's what we're trying to do. We want to be aggressive in enforcing the standards, but we want to be fair and appropriate in doing so. Also, one of Bob's big initiatives has been to bring more significant sanctions to better reflect the gravity of the violations that have occurred. And we've been very successful in doing that in the last year to 18 months. Can we have the next slide, please? Before I turn it over to Kira, just a couple more things. Highlights from our 2022 enforcement activity. We imposed the largest penalty ever against an individual in PCAOB history. We also took the PCAOB's first action for failure to supervise personnel under Section 105C6 of the Sarbanes-Oxley Act. And we also imposed the PCAOB's first sanctions for failing to supervise an unregistered firm, settled the first action involving both a permanent bar and significant penalty, and imposed the highest total penalties in PCAOB history. One of the initiatives that Bob has brought to the fore since he's become our director, and this echoes what our chair has also said, we're trying to use every tool in our toolbox to better protect investors. We're trying to move cases quicker and more expeditiously. And these highlights from 2022 reflect those efforts, and we expect those to continue going forward. And with that, I'll turn it over to Kira.
Thank you, Mike. If you could have the next slide, please. So we wanted to talk a little bit about matters related to quality control violations. And as the slide reflects, since at least 2019, our enforcement program has specifically focused on matters related to deficiencies in firms' quality control policies and procedures. Firms have responsibilities to ensure compliance of its personnel with professional standards, and a proper system of quality control provides firms with reasonable assurance that they will. So during 2022 through the end of the third quarter of this year, the board has settled 25 matters involving quality control standards violations with 25 U.S. and international firms, and they included quality control issues around all 5 of the elements of quality control related to, therefore, independence, integrity and objectivity, personnel management, acceptance and continuance of clients and engagements, engagement performance, and monitoring. So over the next couple of slides, we're going to take a little bit more of an in-depth look and talk a little bit more about some of our cases that relate not only to quality control, of course, but some of the other areas of violations like audit deficiencies and non-cooperation. Next slide, please. So we wanted to start off with Markham LLP, which was a case that was brought this year in June of 2023. We're really excited about this case. This case relates again to Markham, and specifically, as was described in the order, from approximately January 2020 through October 2021, Markham accepted a substantial number of new audit clients, and these included hundreds of special purpose acquisition company clients, which resulted in tremendous increase in the number of audit reports that the firm was issuing in that time period of 2020 through 2021. So it was approximately 225% increase. And as the order describes in depth, the firm added 178 new SPAC clients in 2020. By 2021, they added another 617 new SPAC clients. This was a tremendous spike in the number of issuer audit reports that Markham issued. And it also impacted the partner workload. It created a tremendous increase in the amount of workload that the partners had to, that they worked on during that time period. In fact, as our order described, one partner had like 75 issuer clients one year, and another engaged in quality review partner had 118 audit clients. So in accepting hundreds of new SPAC clients, the firm failed to properly consider whether it could complete these engagements with professional competence. And in fact, during this relevant time period, Markham only rejected new SPAC clients if in the client acceptance process, an independence issue cropped up. And so what our order does is describes how this large increase impacted the firm's ability to comply with PCAOB standards, things from audit documentation. As the order describes, throughout the time period, Markham failed to timely assemble a complete and final set of audit documentation within the 45-day periods of the report release date. And this, of course, was due, again, to the tremendous increase in work that the partners had and the firm had. There were audit documentation binders that failed to include required sign-offs and required work papers. In addition, we found that, again, the impact of them taking on all these clients, again, rolled out into other areas. There were things that the firm failed to do timely. For example, they failed to timely file their Form APs. They failed to perform procedures to identify and assess the risks of material misstatement at the assertion level. They were failing to properly evaluate whether certain matters should be reported as CAMs, critical audit matters. And they were also failing to make required audit committee communications. As a result, Brian, if you could move forward. And again, the slide sort of describes all the issues that I just identified. Could you move forward again to another slide? As a result of these violations, the board imposed a $3 million civil money penalty, which is the largest penalty that's been assessed by the board to date for a non-affiliate firm. The board also required the firm to undertake an independent consultant to review its system of quality control. They required Markham to make functional changes to its supervisory structure related to its system of quality control. The firm has created a new chief quality officer to serve as the head of its quality control system. It created a committee, the Audit Oversight Committee, to also assist with the oversight function of the audit practice. And we'd like to note that this is the first time that the PCAOB has required functional changes at a firm. So again, using those tools in our toolbox, this is something that, again, that this is the first time the board has done that. Finally, I'd like to note for this particular case that we worked with the SEC. It was a good example of collaboration with the SEC, which also brought a case against the firm at the same time as the PCAOB. So now we'd like to talk about the next case. John, would you like to take it over from here?
Sure. Thank you, Kira. And the next matter we want to talk to you about is in the matter of Deloitte & Touche, SAS. And this is the Colombian affiliate of Deloitte & Touche. And this case involves the firm's first audit of a large Colombian bank. And the fact pattern is that between the audit report, the date that the audit report was released, and the documentation completion date, which is a date no later than 45 days after the audit was substantially complete, the audit engagement was selected for internal inspection, and a senior partner with significant responsibilities for the system of quality control told the engagement partner that it had been selected for inspection. And again, this is internal inspection. That engagement partner then told members of the engagement team that the engagement had been selected for inspection, and some of those individuals began reviewing the audit work papers, modifying audit documentation, obtaining additional evidence from the client, and performing audit procedures that had not been performed at the time the audit report was released. Many of these work papers were not properly dated to reflect who performed the work and when it was performed, and who reviewed the work and when that work was reviewed. In fact, the team tracked the changes to the working papers in a document that was kept outside the audit file for much of this time period, and that particular document had over 1,000 entries on it. Just prior to archiving the audit file, that document was added as a work paper, and it noted only 10 items on it. Go to the next slide, please. So, as evidenced by the multiple personnel who participated in this conduct, the board determined that the firm's system of quality control failed to include policies and procedures that provided reasonable assurance that the firm would comply with relevant PCAOB standards related to performing the audit, including standards related to audit documentation and audit performance. There were also violations of the monitoring element of quality control. The monitoring procedures did not provide reasonable assurance that policies and procedures were suitably designed and that they were functioning as intended. In fact, DT Columbia relied on this internal inspection process to monitor ongoing compliance. And informing the engagement partner that the audit was selected frustrated the performance of an appropriate inspection. Once informed, the team made changes to the audit documentation that did not reflect the audit work that performed and at the time that the audit report was released. Next slide, please. Lastly, there were deficiencies in the quality control over assuring that personnel were maintaining independence. Not only was there indemnification language in a certain engagement letter, but there were also impermissible financial relationships that did come to the attention of the firm, and the firm failed to timely address those. Examples were individuals on the audit team who had a brokerage account and loans from the audit client. While the firm did ultimately address these, they were slow in doing so, and in the intervening period, the staff worked hundreds of hours on the audit. As a result of these deficiencies, the firm was sanctioned with a $900,000 civil money penalty and also remedial undertakings to address the areas in their quality control system that were found to be deficient. In addition, the firm is required to ensure that staff obtain an additional 20 hours of CPE on US GAAP, PCAOB standards, and relevant SEC reporting. We're going to talk about another case now that involves BDO's US firm and the audit of a company called AAC Holdings. So AAC Holdings provided addiction services to clients typically as an out-of-network provider. So whereas in-network providers would have a pretty good sense of what they would be paid for certain services, AAC had to develop estimates of what they expected to be paid. And there were three significant estimates in determining what net revenue would be for these, for the services that they provided. One was, what would the insurance and proceeds it expected to get when it submitted claims be? Another one was what bad debt expense would be. What amount did they bill that ultimately determined that they would not collect? And then this is somewhat of a subset of what the insurance proceeds estimate would be, but there were claims that the company had determined they basically expected to receive more than the insurance companies had paid, and they had dubbed these short pays. And so they had a plan by which they were going to resubmit these claims and try to adjudicate a higher amount of basically remittance from the insurance company. And these short pays, interestingly enough, were excluded from the this claim of what they expected to collect on claims. Each of these was identified as a significant estimate by the auditors, and the recent board order relates to failures involved in auditing each of these significant estimates. These estimates impacted essentially all the revenue that was recorded by the company. And you can see that Kevin Olvera is an individual who was sanctioned in this matter, and he served as what was called a focused review partner on the audit, assisting in evaluating the audit work around significant estimates and risks, including the ones that I just described. In addition, Michael Musick served as the engagement quality reviewer on this particular audit. Olvera and Musick failed in their roles to properly evaluate these three significant estimates. And in addition, the firm also violated the underlying PCAOB standards related to the auditing of these estimates. Brian, if you could move forward to the next slide, thank you. So, these violations occurred despite red flags that were known to the respondents. For one of the issues related to these estimates, actually it involved two of the estimates, but was identified by PCAOB inspectors when they inspected the 2015 audit of AAC. The firm's remedial action was actually, the team consulted with BDO's national office on determining what was a reasonable remedial action. And that solution did not address the issues with deficient auditing of what they call the expected insurance value, which were the estimate of insurance proceeds for each of the claims, or the allowance for doubtful account issue that I discussed previously. There were other red flags, though, and they included a significant increase in aged AR between 2016 and 2017 that was not addressed in the determination of the allowance for doubtful accounts, reliance on a hindsight analysis that mixed gross numbers and net numbers and essentially created an apples to oranges comparison that ultimately benefited the company in terms of the size of the reserves that they recorded on their books, i.e. they were under-reserved, and the fact that for the short pays that I just discussed earlier, where the company had previously decided to write off any balance that had not been collected from the insurance companies after initial submission, they began recording 50% of the revenue associated with those particular claims that they identified as short pays. The problem was that the actual experience that the company experienced resulted in a much lower or indicated a much lower rate of collection than the 50% that the company had estimated. So you had information that contradicted the reasonableness of the 50% short pay claim amount. The respondents failed to address these red flags appropriately, and as a result, they were sanctioned, and the sanctions were severe. As you can see, the firm paid a $2 million civil money penalty. Mr. Olvera was limited in his ability to act in certain roles for a period of a year and was also required to take additional continuing professional education and was sanctioned a $35,000 civil money penalty. Mr. Music, in his role as engagement quality reviewer, was also required to take additional continuing professional education, was censured, and was also sanctioned with a $25,000 civil money penalty. With that, I'm going to turn it back over to Kira to discuss our next case.
Thanks, John. So returning to this quality control theme, the board imposed sanctions on a firm called Total Asia Associates, which is a NAF firm that's based in Malaysia. And this case was interesting in that here again, the board did find that the firm's system of quality control failed to provide, reasonable assurance that the work performed by its firm personnel met the applicable professional standards. And what we found in investigating this particular firm was that they were using outdated audit methodology, practice aids, things of that nature, dating back to 2015. And they never updated that audit methodology. So the methodology didn't include requirements related to CAMs, no requirements with regard to disclosing CAMs in the audit report or in discussions with the audit committee. So obviously that was problematic. We also found, during the investigation, and the board order describes that the engagement partners and engagement quality review partners didn't get any training at all related to US GAAP, PCAOB rules and standards, and SEC rules and regulations. So again, that was problematic. And then we found that the firm itself had performed an internal inspection, or cold file reviews, I should say, of its own policies and procedures and found deficiencies there related to specifically engagement quality review, I believe documentation. And so for these reasons, we brought the case to the board, and the board imposed the following sanctions: a revocation of the firm's registration with the right to reapply after 2 years and an $80,000 civil money penalty. Next slide, please. Or just next two slides. Next slide. After that, Brian. Thank you. And so we just thought we'd just touch briefly on a couple of other matters that were brought by the board. And this one, again, is still another quality control violation. Here, what we found interesting was that the firm failed to improve its system of quality control despite being on notice over the course of various PCAOB inspections of those quality control deficiencies. For some odd reason, the firm failed to improve despite being told by the board, specifically the PCAOB inspectors, I should say, what those deficiencies were. And as a result, the board, sanctioned Marketson. If you could move ahead, Brian, to the next slide. We imposed, a revocation of the firm's registration with the right to reapply after 1 year, a $30,000 civil money penalty, and we required the firm to undertake certain remedial measures to improve its quality control system before it can reapply. The next slide, please. We also wanted to mention a case that we brought related to two Friedman partners. Mr. Wong and Mr. Aaron Kratz were partners at Friedman LLP. And Mr. Wong was an engagement partner. Mr. Aaron Kratz was an EQR. They were partners on the audits of King Gold Jewelry, which was a China-based issuer, I believe for the 2016 through 2018 audits. And here the board found that for 3 consecutive audits, Mr. Wong had failed to exercise due professional care and skepticism by failing to obtain, as noted here, appropriate audit evidence about the existence of significant gold inventories that were held by third parties and pledged as loan collateral, and that he failed to identify or evaluate significant unusual transactions, including transactions related to this pledged gold. Next slide. Mr. Aaron Kratz, also, who was the EQR, we found failed to evaluate the engagement team's assessment of and responses to these significant risks with due professional care. For that, the board barred Mr. Wong with the right to petition to associate for after 2 years and impose a $100,000 civil money penalty, which we believe is, of course, sizable. And Mr. Aaronkrantz himself, who was the EQR again, he received a $25,000 civil money penalty and a 1-year bar. Next slide. We also wanted to end our discussion about our cases by just reminding folks about this case, the Jonathan Taylor and Spillman, Konigsberg and Partner LLP case. And this involves non-cooperation, which is, we talked about earlier, the board has zero tolerance for non-cooperation, and this is evidence of that. Here, we found that Mr. Taylor had misled PCAOB inspectors and investigators. Specifically, he had altered and then backdated a tremendous number of audit work papers prior to an inspection, and then made up multiple false statements, of course, to the inspectors. As far as the investigation, he did it again. He provided the investigators with false and misleading information. He altered work papers and then falsely certified that he had provided all relevant documents. Next slide. As a result of that, I should also say the firm itself was also found to have violated quality control standards. They failed to obtain multiple AQRs and failed to timely or accurately report, file certain required reports by the PCAOB. We barred, or the board, I should say, permanently barred Mr. Taylor, and he received a $150,000 civil money penalty, which I believe was the highest penalty the board has assessed against an individual in its cases. And the firm itself was also had its registration revoked for a period of 5 years, and it received a $150,000 civil money penalty. So again, this sort of underscores how the board treats and feels about non-cooperation. Next slide. Finally, we just wanted to, mention our commitment, of course, to ensuring investor protection. And we just wanted to show the TIPS hotline, the information here about how to contact the PCAOB if, in fact, the public has tips and or referrals. This is the information that one would use in order to communicate with the PCAOB in that manner. And I believe that concludes a formal presentation. No, Mike, if you have anything.
Yeah, thank you, Kara and John. I would just add, if Bob were able to be with us today, he would be the first to say that a number of these matters, if not all of them, occurred before he arrived. But I think what we are all very excited about to have Bob Rice join us as our director is that he brings a wealth of experience both in the private and public sector, having worked in the U.S. Attorney's Office, the SEC, major law firms, Deutsche Bank. And he would say that his heart has always been in the public sector, even though he worked quite a bit in the private sector to pay the bills. So we look forward under his leadership going forward to building upon our success the last year or two, and including bringing action sooner. Also, all of the other things that are laid out in the board strategic plan that we've talked about today. With that, we might have a few minutes for questions.
Thank you, Mike. So I see Hal, Jennifer, Nemet, and Jeff. So Hal, you're next.
Okay, 3 quick questions. One is, when was the tips line started, and how many tips have you gotten so far?
John, I don't know if I have the exact date, but I know the tips line, we've had it for quite some time. And so, every year I think we're not like the SEC, we don't get, the tens of thousands of tips, but we certainly do get quite a few per year. I don't know, John, do you have more specifics on that?
Yeah. Just to echo what you said, Kira, I mean, we've had the tips line's been around for quite a while. And in terms of the number that we get, I mean, it varies by year, but it's approximately 250.
Is that disclosed? Is that publicized? I have to admit, I did not know that until that last slide?
So I'll jump in here. We do advertise our tips and complaints system. In fact, if you go to our website, one of the first videos that I put on the website when I became chair is a video advertising our tips and complaints line and encouraging people to provide complaints and tips to the PCAOB.
I'm going to go back and look at that because I have to admit I was not aware of that. Second question was going back to, and I think Kira, you had said several times you were distinguishing between the engagement partner and the quality review partner or quality control partner, whatever the name may be. Are there any rules or standards that dictate the relative seniority between those two, the engagement partner and the quality review partner? I'm asking that because I'm interested in knowing, is there a overweighting, if you will, of problems when the quality review partner is of a lesser, lower seniority or experience relative to the engagement partner?
There are, yes, specific standards that dictate, what an engagement quality review partner should do in an audit and or review. And also, there are standards that inform what an engagement partner should do, in an audit. So yes, we take that into account when we're looking at investigations and the conduct of individuals who occupy those particular positions. An engagement quality review partner comes in sort of, to look at some of the work that's done by an engagement team during an audit and make certain evaluations about the significant judgments and conclusions reached by an engagement team. So the standards themselves do help to distinguish what they do, and that informs how we look at that as well.
I'm sorry, I appreciate that those standards that dictate what each do, but I'm thinking of a first-year partner doing the quality review relative to a very senior, very well-known partner within the firm. Sometimes that junior partner is going to could be intimidated. And I was wondering if there's some way to understand, if you track the statistics, where there's a significant disparity and whether or not that quality control partner would actually be as effective as if they had, relative to whether they'd been a more senior partner, again, versus the engagement partner.
I will say the EQR standard does, this may not address the specifics of your question, but there is particular guidance as to be an engagement quality reviewer, and the fact that they are at a similar level, at the same level as the engagement partner. So you don't have managers acting as engagement quality reviewers, at least compliantly doing it. But as it relates to their experience, I mean, it would be something that we would have to kind of evaluate on an investigation by investigation.
And I'm going back on my own personal experiences, going back obviously a few decades now. I would be very interested to know that, because I think that's one of the things that I observed, that there was a disparity, and sometimes that quality control partner could be stifled, if you will, and not voice all the concerns that they may have had. I want to go back to Mike Davis's slide number 10, and I just had a question. You emphasized a significant step up in enforcement for the years 22 and then for what we've gone through in terms of 23. Again, relative to 2020 and 2021. Is there any way to look back and say what those numbers would have looked like if there had been the same level of enforcement as we're seeing in the past 2 years relative to those earlier years? Because what I'm interested in is, has there been any improvement, or is it, because right now what I'm seeing is a net stricter enforcement, but I can't break out or tease out if there's actually been any improvement over that 4-year period.
Well, that's a very good question. I'm not sure that data is easily available. I think if you do look at the amount of sanctions, that has clearly gone up in the last year or two, but it's very hard to do an apples to apples comparison because each case it's different. You also have the issue that conducting investigations, as I mentioned, was very difficult during the pandemic. I think if you look at the overall trends, the emphasis of this board on strengthening enforcement and enhancing penalties is definitely reflected.
Yeah,
Thank you,
I
Mike.
appreciate that. Oh, I'm sorry. Go
Sorry,
ahead.
thank you, Hal. I just want to make sure that we stay.
Yep. Okay.
You know, we move on to the next
Yep.
person for their question. Jennifer, I see your hand up.
Yeah, yes, thank you. And thank you to the DEI office for that excellent presentation. I have two very key questions I wanted to ask. The first question is picking up on the level of civil money penalties that have substantially increased. Has the board, either the inspectors or the DEI, noticed that this has caused a deterrent and led to an improvement in auditor conduct? And then the second question, I wanted to find out more about the Markham case with the SPAC clients. You noted that there was a significant workload on the audit partners, but it also seems to me that there was also a significant stress on the workload of all the members of the audit team. And so does your investigation go in deeper to look at whether the firm was facing challenges in recruiting staff and auditors to work on the engagements, or did the firm just not decide to staff the engagements? And the reason I wanted to know more about this is I'm curious as to whether the current pipeline challenge and issues with recruitment and retention and accounting is leading to directly impacting audit quality.
Hi, Jennifer. Thank you for that question. I'll let John or Kara answer the harder part, which is your second question. And I'll take a stab at your first question. I think one of the things we've really been seeing is in recent months is that, and this is somewhat anecdotal, but opposing counsel, firms, individuals, I think the message is really starting to get out there that, you know, the PCAOB means business. And at first there was, you know, great resistance, but we're starting to see that, you know, it will take time for it to show up in audit quality improvements. But I think the increased sanctions and the more aggressive approach we've been taking in the last year is really starting to bear fruit. So hopefully, you know, the audit cycles take a while. Hopefully, you know, within the next year or two, you're going to see some significant improvement.
Thank you, Mike.
And with regard to Markham, just quickly, you know, the order did focus, as I said, and I think you noted, on partner utilization. And, you know, we focused specifically on the partner workloads because we did think that did have a significant impact, of course, on the ability of the firm to comply, again, with various standards, including audit documentation. The order doesn't address sort of below that level. And so I'm sort of constrained by, you know, I can tell you what's in the order, but that is an excellent question. And I can't have, you know, I do wonder if, in fact, you know, what the other, you know, collateral consequences, of course, of those types of significant workloads were on others on the teams.
Thank you, Kara. And I see, and thank you, Jennifer, for that great question. I see Nemet and Mary's hands. So Nemet, you're next.
Thanks, Saba. I thank everyone for the wonderful presentation. I think one question that I had was, is there any concern at all that audit firms, as they become more familiar with the investigation process, that they're able to better game this process? And I especially worry about this with respect to, say, larger firms that are better equipped to deal with enforcement activities relative to the smaller firms, because a lot of the examples that were provided during the presentation, they related to smaller firms rather than the big six firms, I would say. So if you could comment on that, I'd be curious to hear what you'll have to say. Thank you.
Sure. I'm happy to take a stab at that one. it's very difficult to game the system when it comes to the PCAOB. We have a tremendous staff. If you look at the age of experience, even the age of experience on this call, Kara's been at the PCAOB almost 20 years. John's not too far behind, and I'm not too far behind John. So there's a tremendous amount of experience throughout the entire staff. Firms are also required to cooperate with our investigations, and if they don't, there's serious consequences. So, one of the reasons that investigations may take a little longer than sometimes folks would like is that we're very, very thorough. We leave no stone unturned. We move as expeditiously as possible. But, the audit record is what the audit record is. And the firms that have tried to game the system, it usually doesn't work out very well for them. So that's not a great concern.
Thank you, Mike. And so we just we're running behind, so I'll just ask Mary and Jeff to ask their questions so we can take a quick break and be back for the next session. So Mary, and then.
Yes, thank you. That was an excellent presentation. I actually learned quite a bit. My question is, setting the enforcement actions, the dollar amounts, the penalties, are there policies and procedures, and do these penalties relate to the size of the firm or the fees of the firm, or how are you deciding what to sanction and how much? The dollar amounts that you're imposing, I'm just curious as to if there's some guidelines for that.
Yeah. Mary, I think.
Oh, go ahead, John.
I think the penalties are intended to be deterrents, and so what might be a deterrent to a smaller firm dollar-wise is not as much of a deterrent to a larger firm. In coming up with the sanctions, we're obviously looking at the egregiousness of the conduct, the extent of the conduct, how it is sort of the culpability is allocated between individuals, the firm, how many individuals, and other factors. Is it repeat behavior? Is it intentional? Is it not intentional? And so, and I think when it comes to civil money penalties, we are looking at the size of the firm as one part of the input to it all. But Mike, I don't know if you wanted to add anything.
The other thing I would add, Mary, is our guiding light is we want a sanction that will provide a deterrent, and our guiding light is to protect investors. So there are, probably a dozen different factors that go into, how we arrive at a sanctionable amount. But protecting investors is a key, and deterrence, both as to the individual firm that has violated our standards, but also, to discourage others from, I think, Nimit or someone asked about gaming the system. You don't want to sanction that, folks feel it's just a cost of doing business. So those are
kind of what I was thinking,
Yeah. I
mean, is it really a deterrent, or is it, oh, well,
I don't think, I've never heard someone who was sanctioned who didn't feel it was a deterrent. Or at least that's, everything we've heard. So we think, under the current board and our leadership, we've really struck a good balance, and hope to continue that going forward.
Thank you, Mike. And thank you, Mary, for that great question. Jeff, and after this, we'll take a break. You're next, Jeff.
Thank you very much, Saba, and thanks for that excellent presentation. I'm just going to throw out 4 questions. I know we're out of time, but maybe you could reply in the chat box or directly to me at some later time. Here's my 4 questions. The first one is an issue I've brought up in the past, I think at this meeting, or maybe it was at the SEIEG meeting, where there's a distinction between the amount of information the PCAOB enforcement can provide publicly about an action as compared to the SEC. And that goes back to language in Sarbanes-Oxley. But I wonder if there's been any movement at all in that space where we can somehow reduce the gap between what the PCAOB can say and what the SEC can say on enforcement actions. That's one. Number two, in the matter of Markham LLP, two questions. One, the press accounts are that there was another firm that actually had an even higher volume of SPAC audits than Markham. So I just, given the activity at the time, I'm just curious. It seems to me that a number of these things you found with Markham would likely also apply to this other firm. And I wonder if there's anything you could say about that. Also, with respect to Markham, also it's been shown that after the de-SPAC transaction, that the auditors, at least 2/3 of the auditors of these newly public companies are the large accounting firms. And I'm just curious, given the process that occurred in the SPAC transactions that led to these public companies, whether there's any additional risk that the PCAOB considers in its inspection process with respect to these newly public companies that appear to have a pretty flawed corporate governance process that led to them being public companies, and now 2/3 of them are audited by the 4 largest accounting firms. So I wonder if there's any consideration to that as a risk factor in considering inspections. My final question relates to the matter of Deloitte and Touche SAS, where your second bullet point on page 18 talked about independence issues, including indemnification clause. I'm really curious about that because in my experience, talking to auditors in the audits of private companies, it's very, very common for firms to have indemnification clauses in their engagement letters. I know there's a different standard for public as opposed to private companies, but it doesn't surprise me that you found this in Deloitte SAS in Columbia. And I would suspect that there's a number of other, my guess is there's a number of other PCAOB registrants that also might commonly use indemnification clauses in their engagement letters. And I wonder if you have any comments on that. So those are my 4 questions. Thanks very much.
Jeff, I'll address, I think, most of them. So as you know, Sarbanes-Oxley prevents the PCAOB from discussing any enforcement matters by law, including whether or not they've been initiated. But I will say, and I have said before, that if Congress decides to take action on that to change that, I very much support increased transparency to let investors know that the PCAOB has brought enforcement proceedings against firms so that they can use that information. And I will note that in our inspection priority, SPACs and de-SPAC transactions continues to be a priority for us, so we are considering that in our inspections. So I think I answered most of your questions, if not all, but I do appreciate, first of all, our enforcement team and their presentation today. Thanks to all of you, Mike, John, Kira, and I think the questions that the IAG had were very thoughtful, so thank you for those. Sav, I turn it back over to you.
Thank you, Chair Williams, and thank you, Jeff, for that great question. So we'll take a quick break. We'll be back at 2:20. I know we're running over, but we'll be back at 2:20 for the next presentation.